Over 70% of millennials dream of owning a home one day, and more than 80% of people think that owning a home is a great investment. Indeed, many people believe paying rent every month is basically throwing money away. But is that really the case? With the recent surge in real estate prices, it may seem like buying a property is a good investment. However, the price increases in the last 2 years represent an anomaly in the market. When you look at historical statistics, this is far from the norm. House prices do not normally increase by 10% every year, nor do they necessarily increase every year. Hi, my name is Maxime Dubé, Portfolio Manager at Claret, and in this video I will explain 3 reasons why homeownership is not always a good investment and why renting might not always be such a bad idea. Many investments pay an income, whether it's interest, dividends, or rent. A good investment pays you for your capital. In the case of a house, it is the opposite. You have to consider property taxes, school taxes, electricity, renovations, contingencies, interest on the mortgage, insurance, and all of this without even counting your time and headaches. You cannot recover these expenses. In reality, your property is costing you money every year just to maintain its value. Your house is not a liquid asset. If your property is an asset that will be used to finance your retirement expenses, you will have to consider selling it at some point. The problem with this logic is simple. Where will you stay after you sell it? Will you be willing to go back to renting? The only time this works is when retirees get older and prefer to move to a retirement home, autonomous, or assisted living. If you want to enjoy your home for as long as possible, even in retirement, you will have to consider the expenses of owning your home rather than viewing it as an asset. Making a profit doesn't necessarily mean that it was a good investment. Before we dive into an example, it is important to specify that each demonstration depends on the assumptions used. So let's say you buy a house for $500,000 today and live in it for 10 years. Your down payment is 20% or $100,000, so you don't pay a CMHC premium. You take out a mortgage for $400,000 at a fixed rate of 4%, which corresponds to historical mortgage averages. Let's use the assumption that the value of your home increases by 3% per year after inflation, which is the rate at which house prices have increased on average in Canada since 1970. This means that you could sell your home for $678,000 in 10 years, and your mortgage would be roughly worth $284,000. So when you sell the house, you will receive $393,000 net of mortgage repayment. That's a return of almost 300% on your initial $100,000 down payment. Now, let's subtract all the unrecoverable costs incurred over 10 years. With a 4% rate on your mortgage, you would have paid $136,000 in interest. Let's also say that you spend an average of 1% of the value of your home on repairs each year, so 1% of $500,000 over 10 years, that's $50,000. If you have a condo and fewer repairs than a house, include the condo fees instead. In Montreal, you would have paid roughly $6,000 in welcome taxes, $30,000 in municipal taxes, and $5,000 in school taxes. In total, over 10 years. Finally, let's subtract the legal fees and the moving expenses. After including all of these expenses and ignoring the inflation on these costs, you are left with $163,000 in your pocket, a profit of $63,000 on your initial investment, or about 5% per year. A diversified stock portfolio invested 40% in Canada, 40% in the US, and 20% in the rest of the world would have generated a return of 5.7% after inflation over the same period. This means that investing your down payment at this same return would have given you a profit of $74,000 after 10 years. A little more money, but with a lot less headache. Note that if you hold the portfolio outside of your registered account, you will have to pay taxes on income and gain, which may further reduce what you get in the end. And by the way, even if your house has increased in value recently and very quickly, without you having to lift a finger, chances are your neighbor's house has also increased. So unless you're thinking of moving to an area where properties are more affordable, relocating will cost you a lot more. Owning a home is a major life goal for many Canadians. but we'd caution against using homeownership as a primary investment vehicle. Be realistic about the real cost of home ownership over time, and if you're lucky, you'll be able to recoup some of that money when you sell. For some people, buying a property and then paying off a mortgage is kind of forced savings that allows them to save money they would otherwise have spent. If you're disciplined, investing annually into an RRSP or TFSA may be a better long-term investment. For more investment tips, visit our website at claret.ca and don't forget to click on the subscribe button.